The US dollar woke up today and regained its footing. This time, the greenback rebounded in the light of an exceptionally strong small business optimism index released yesterday. If a secondary report had such an impact, what can we expect when inflation data coming out today? At the same time, everyone understands that the potential acceleration of prices in the US in the fall of 2024, driven by tariffs and taxes promised by Donald Trump, could gain momentum in 2025. In such a scenario, the Fed Reserve may have to abandon its planned pace of rate cuts. This could happen as early as the meeting concluding on December 18. For instance, according to FEDWATCH tool, 86% of the market currently expects the US Central Bank to lower the funds rate by 25 basis points next Wednesday. However, economic statistics could disrupt these forecasts. If prices in the US, particularly the core components, rise, market participants will have to revise their forecasts, advocating for opposing rate cuts. As a result, the balance between the two sides could shift to a 50-50 split. In this context, the US dollar will be the main driver of trading, as the American currency is highly sensitive to the pace of inflation. By the first half of the Wednesday, its six-currency index was already holding steady at an elevated level of 106.50. Traders are now braced for the higher volatility on Wednesday and Thursday. The key metrics for the currency market today remain the US Consumer Price Index for November. You can check out the traders' calendar for information on a page in economic data and the impact of economic reports on trading instruments. The euro, being a risky asset, does not generate much enthusiasm among buyers, especially against the backdrop of Donald Trump's unpredictability, as he has promised protectionism toward his European partners. The most prudent approach in such a situation is to wait and see what turns into reality and what proves to be mere rhetoric. For this reason, the euro-dollar pair has been trading within the range of 1.0450 to 1.0600 for about a month, moving within a long-term downtrend channel. Moreover, if the US CPI is low and increasing, it will be an excellent gift for the bears, allowing them to expand the short positions already formed from the 1.0615 level. At the same time, amidst US dollar volatility, analysts admit the attempt at a bullish correction at a test of the technical resistance at 1.0565. However, in any case, this will likely be followed by a drop and the continuation of the pair's decline. Tomorrow, the potential target for the euro's price drop could be the area below 1.0375. For more sustainable growth, the euro-dollar pair needs to break above their psychological resistance level of 1.0500 and consolidate in this area on the daily time frame. Tomorrow, on December 12, the European Central Bank will issue its statement on the refinancing rate. The consensus suggests a 0.25% rate cut, and this scenario has already been priced into the euro. Nevertheless, the single currency is in for a wave of volatility, especially during Christine Lagarde's press conference, which will start half an hour after the policy announcement. If the ECB president's comments include any hints regarding future rate decisions, the euro's amplitude on the trading chart could increase even further. Another key report tomorrow will be the US factory inflation data, the November Producer Price Index. The annual PPI is expected to accelerate to 2.6%. If this happens, the US dollar will strengthen and the euro's chances of significant gains will be reduced to almost zero. Meanwhile, oil prices are holding their ground against the strong dollar quite successfully. Following gains during the previous two sessions, benchmark crude prices remained on the rise on a Wednesday. Brent is trading within the range of $72 to $73 per barrel today, and this growth was driven by geopolitical tensions and the expectations of new economic stimulus measures in China. Besides, Beijing announced its intention to ease monetary policy in the near future. However, China's authorities have made plenty of promises this year, yet the economy remains sluggish. As a result, traders' enthusiasm typically lasts just 1 or 2 days, meaning oil prices are likely to start declining predictably. Data from the American Petroleum Institute today showed an increase in oil inventories by 499,000 barrels last week, while the market had expected a decline of 1,300,000 barrels. However, API's reports are based on voluntary data from refinery operators, storage facilities, and the pipeline companies. Official data from the US Department of Energy is set to be released later today at 13:30 GMT. Later today, after the market closes, the CPI for the Russian economy will be released as well. The index is expected to accelerate from 8.5% to 8.8% on a year. Most experts believe that the Russian economy will enter the year with an even higher level of inflationary pressure than previously expected, and this comes as a no surprise given the central bank's key interest rate hovering around 21%. Meanwhile, the current pace of inflation needs upgrading inflationary expectations in the future. At the same time, a trend of a slowing economic growth has already taken root in the country, which will impact the dynamics of consumer prices and as a ripple effect further weaken the Russian ruble. The official US dollar exchange rate set today is 100 rubles. Meanwhile, the dollar ruble pair is trading within the range of 101.40 to 104.60. So that's all for today. We monitor developments in the financial markets. Subscribe to our channel and stay up to date with the latest news with us. See you tomorrow.